Real estate investment trust ETFs. Should investors invest in them? Or is it better to stick to individual REITs? That's the question I'm looking to answer in this video. But look at the REIT ETF options available to a Singaporean investor, examining their pros and cons as compared to individual REITs, and finally comparing their performance to individual S-REITs in the market. Let's start by first looking at what REIT ETFs are all about. Like all ETFs, REIT ETFs tracks the performance of basket of counters, or REITs in this case. Depending on which REIT ETF you're looking at, some ETFs purely track REITs listed in Singapore, while others include overseas REITs listed in countries such as Australia or Hong Kong. That said, even for REIT ETFs that purely track Singapore listed REITs, a couple of these REITs also have overseas exposure via their own property portfolios. In addition to geographical composition, the 5 REIT ETFs also differ in their expense ratio and distribution frequency. The REIT ETF with the lowest maximum expense ratio will be the Nikko AM Straits Trading Asia x Japan REIT ETF. It's also the only REIT ETF that does quarterly distributions instead of semi-annual distributions as per the other REIT ETFs. Now that we know the different REIT ETF options available in the Singapore market, let's consider the pros and cons as compared to investing in individual REITs. These pros and cons can be broadly categorized into 4 categories: costs, risks, research required, and finally potential returns. Let's start with the first category on costs. For an investor investing in individual REITs, their associated upfront costs, not accounting for any future gains or losses, will be purely limited to the trading fees incurred when buying or selling a REIT. On the other hand, a REIT ETF investor would not only have to pay the associated trading fees, but also the management and other relevant fees and expenses related to the ETF. These fees can range from anywhere between 0.55% per annum to 1.18% per annum. While you do not pay these fees upfront, they are already accounted for the net asset value of the ETF. To illustrate the impact of fees on investment returns, let's assume a 5% annual return on the investment of $100,000 over a period of 10 years. The investment will have grown to $163,000 without any fees involved. With a 0.5% expense ratio, the investment value will be $155,000, representing $8,000 difference on an average of $800 annually over a period of 10 years. At an expense ratio of 1%, the investment value will drop to $148,000, representing a difference of $15,000 or on average $1,500 annually. This is why it's so important to look at total expense ratio when investing in REIT ETFs, as it can have sizable impact on investment returns. On the other hand, an individual REIT investor will not face such an issue and will be able to reap the full performance of their REIT investments. Besides considering the impact of expense ratio on their investments, REIT ETF investors also have to think about withholding taxes on the dividends coming from their individual REIT ETFs underlying constitutes. While most REIT ETFs on the Singapore market contain REITs listed in countries that do not have withholding taxes on dividends flowing to Singapore, the UOB APAC Green REIT ETF has significant exposure to Japan-listed REITs. This means that any dividends from these Japan REITs will automatically be subjected to a 15% cut due to withholding taxes. Thus, this is another cost to consider on top of the ETF-related fees and expenses. Now moving on for the category of costs, let's look at risks next. When it comes to risks, REIT ETF investors no doubt have a larger margin of safety as their risk is averaged out between all the REITs in the ETF's portfolio. Furthermore, they automatically help investors diversify their REIT exposure, be it by sector or geography. On the other hand, an individual REIT investor to DIY their own REIT investments, not just to ensure that their property is diversified, but also to make sure that investment perform well over the long term. As picking a bad REIT to invest in can have a significant negative impact on the overall returns. In this sense, the risk that individual REIT investors are exposed to is 3-way: market sentiment risk, individual REIT property portfolio risk, and finally individual REITs management team risk. While it might seem daunting, an individual REIT investor has more flexibility over their REIT portfolio as compared to a REIT ETF investor. If you look at the sector composition of the 5 REIT ETFs, you can see the majority of it are retail, industrial, and office REITs. This means that REIT ETF investors have to accept and be comfortable with the relevant sector allocations and don't have a choice to be either underweight or overweight in certain sectors. While investors can invest in 2 or more REIT ETFs, doing so might be counterproductive as it will mean that they will be double dipping in certain REIT counters, which can significantly skew their overall portfolio returns. In contrast, an individual REIT investor can customize their own REIT portfolio to suit their own risk appetite and investment aims. So with both the category of cost and risk covered, let's look at the category of research next. But let me tell you a hard truth. If you want to invest in individual REITs, be prepared to do tons of research. Doing so not only allows the investor to assess the fundamentals of the REIT, but also provide them the conviction to hold or add on to their positions during market corrections. This means the average individual REIT investor has not only been up to date with their REITs ins and outs, but also the assess sector-specific implications to the REIT's growth prospects and determine a good entry or exit price when necessary. And to top it off, it can be negatively impacted by decisions of REIT management teams. While online mediums like YouTube videos and blogs can help to reduce the information gap, individual REIT investors still do the legwork to develop their own understanding and conviction in their own invested individual REITs. Contrast this to a REIT ETF investor whose research is largely centered around the ETF's total expense ratio, underlying holdings and compositions, tracking error, and possibly the ETF's market liquidity. See the difference in work required? All the extra work for the individual REIT investor is part and parcel of potentially getting higher returns on their investments. Speaking of higher returns, individual REIT investor can certainly get better returns than REIT ETF investors by investing in a few good performing REITs over the long run. As REIT ETFs invest in a basket of REITs, their respective returns will be the average of both good and bad performing REITs in their portfolio. Thus, in the long run, if an individual REIT investor can consistently invest in good performing REITs, their market returns and dividends will likely surpass that of a REIT ETF. To illustrate how easy or difficult it is to invest in REITs that outperform REIT ETFs, let me show you a performance comparison over the past 5 years. As only 3 out of 5 of the REIT ETFs have been in the market for more than 5 years, I'll be benchmarking these 3 ETFs against 31 non-substandard REITs have been on the Singapore market for more than 5 years. So based purely on market performance, without accounting for distributions, 16 of 51.6% of the REITs outperformed the average performance of the 3 REIT ETFs. If distributions were included, this figure will rise to 18 or 58.1% instead. As you can see, the figures remain quite reasonable, which should provide some encouragement to individual REIT investors. It also implies that with good research, individual REIT investors can definitely outperform REIT ETFs in the long run. At the end of the day, the choice to invest in individual REITs or REIT ETFs will solely be down to the amount of effort that the investor wants to put in. Personally, I'll stick to investing in individual REITs as I feel that I can get a higher return than what REIT ETFs can offer me. If you want to start investing in better performing REITs, check out my previous video over here where I highlighted the things to take note of when analyzing individual REITs. It won't be a guaranteed success, but should help you filter out better performing REITs in the long run.